So, a very good morning, all of you. Welcome back to our class after a short vacation. As earlier understood, we are looking at a chapter called Financial Statement of a Companies. So, financial statements mean final accounts. Final accounts consist of two things. One is the balance sheet, other is the profit and loss account. So, as earlier understood, balance sheet consists of assets and liabilities. The liabilities consist of shareholders fund, non-current liability, current liability, whereas assets consist of non-current asset and current asset. So we understood all this thing according to the part 1 schedule 2 of the Companies Act 2013. Now today we start off with the new topic, that is profit and loss account. So the first question is why the profit and loss account is prepared as per part 2 schedule 3 of the Companies Act 2013. Why do we prepare a profit and loss account? We prepare a profit and loss account in order to know the profit or a loss. Okay, how do you arrive at profit? If income is more than the expenditure, it results in profit. If expenditure is more than the income, it results in loss. So essentially in profit and loss account, we take into account the expenses and incomes. However, in profit and loss account, incomes are also referred to as revenue. So now we come across to the pro forma of a profit and loss account. The pro forma of a profit and loss account as per the schedule part 2, schedule 3 of the Companies Act is as follows. It has a heading statement of profit and loss account of dash company for the year ended dash. We have particulars followed by a note number, current year amount. So essentially the profit and loss account is into two parts, the income and the expenses. So already I told you that income is also referred to as revenue. So under the incomes or revenue, we basically have two categories. One is a revenue from operations and the second is other income. Both added together will give the total revenue. Whereas the expenses are classified as follows. The first thing is cost of material consumed. The second thing is purchase of stock in trade. The third thing is change in inventories. So for the sake of convenience, let us consider this as one set. Now the second set has employee benefit expenses, financial expenses, other expenses. Let us consider this three in one set. And the last, let us take depreciation. All these put together will give you the total expense. So as already understood, income minus expenditure will give what? Profit before tax. So how do you arrive at profit before tax? It is total revenue minus total expense will give the profit before tax. From that, if you reduce the tax, we will get profit after tax. That is nothing but the net profit of a company. Now let us go back again. Revenue is nothing but income. Revenue from operations. So essentially all these further explanation is given under the notes to accounts, which you will be understanding a little later. So essentially income has two things, revenue from operations and other income. So income has two things, revenue from operations, other income. Expenses, the first set. So suppose if the business is a manufacturing concern, then we have material consumed. If the business in the nature of a trading concern, then we have purchase of finished goods or purchase of stock and trade. So like that, the first set we can remember as cost of material consumed, purchase of stock in trade and change in inventories. So the first set we can consider as cost of material consumed, that is for a manufacturing concern, purchase of stock in trade, that is for a trading concern, and change in inventories. This is the first set. The second set we can talk it as employee expenses, financial expenses, other expenses. The second set we will categorize as employee expenses, financial expenses, other expenses. Last, at the end of the year, we usually calculate depreciation. So I think it is easy to recall all this 6 categories if you're dividing into 3 different parts. The first part cost of material consumed for a manufacturing concern, purchase of stock in trade for a trading concern, and change in inventories. The second set, employee expenses, financial expenses, other expenses. Actually, it is employee benefit expenses, but to just get the rhythm, we call it as employee expense, financial expense, other expense. And at the end of the year, it is depreciation. Like that, we get total expense. So, total revenue minus total expense will give profit before tax, less tax will give you profit after tax. So, this is a way in which we can recall the statement of profit and loss account. Now, having understood the various categories of revenues and expenses that are need to be taken in a profit and loss account, now let us understand each and every category. The first category under revenue was revenue from operations. Revenue from operations, that is income from your business operations. What is the major income for every business? The major income for every business is nothing but sales. So revenue from operations implies sales. So whenever we take sales, we have to take sales minus sales return will give you the net sales. So these sales are the gross sales minus sales return, means whatever goods have been returned to us because the goods were defective, if you minus it, we get the final answer, that will be net sales. So under revenue from operations, so revenue, income from operation, from your business activities. The major income from business activities is sales. So we don't take gross sales. From gross sales, we reduce sales return. Whatever is the net sale will be the final answer. Now, the second category under revenue was other income. So now what are the other income apart from sales? We have interest received, dividend received, profit on sale of asset, and any other income. So these incomes we usually call it as non-operating incomes, means incomes not directly from your business operations. So interest received on what? On investments or any deposits with the bank. Dividend received on investment in shares of other companies. Any profit received on a sale of an asset, and any other income like bad debts recovered, tax refund, etc., etc. So these are the various things that we take under the other income. So we have to prepare notes like this. Take these individual amounts here, take the total amount here, and this total amount should be reflected in the main statement only. Next, when we come to the expenditures, we have first cost of material consumed. Generally, if it's a manufacturing concern, they convert raw material to finished good. So how do you get what is the cost of the actual material that is consumed for the production of the finished goods? So we take the opening stock of raw material, we take purchase of raw material, and we minus closing stock of raw material. That will give what is the cost of material consumed. So it is opening stock of raw material, add purchase of raw material, minus closing stock of raw material will give what is the material actually consumed during the year. The next category is change in inventory. Change in inventory. So generally when we talk about inventory, we are talking about stocks. So stocks are of three types. One is stock of raw material, next is stock of work in progress, third is stock of finished goods. So because stock of raw material opening and closing stock is already considered here, we are left with the other two stocks, that is stock of work in progress and stock of finished goods. So what we do is we take opening stock of finished good minus closing stock of finished good. Similarly for work in progress, we take opening stock of work in progress minus closing stock of work in progress. Then what about raw material? Raw material opening and closing stock have been already considered here. So therefore, when you took a change in inventories, we are taking the remaining stocks, that is stock of work in progress and stock of finished goods.